Okay, we are live. Right. Good morning, everybody. My name is Gavin. Welcome to Alphachain's weekly market analysis. It is the 1st of August, so we're starting a new fresh month in trading. And what we're going to start off with is let's go back and revisit last week's trading session. We'll look at some of the highlights from last week's trading session, and then we'll look at the week ahead. And we sort of, break down key areas that you should be focused on for the upcoming week. And as you can probably see in the title itself, the key title of this session is first the Fed, then the ECB. Now it's over to the Bank of England. Okay, so towards the end of the week, we have a focus being Bank of England. Are they going to raise rates? But without a doubt, that's likely to happen. But how much are they going to raise rates by is the sort of key question from this session that we'll discuss in detail. Okay, so starting off with last week, what happened in the previous week? Well, I think the highlight would have been last week's Federal Reserve rate decision, as well as the press conference. Okay, so as expected, the Federal Open Market Committee, so the FOMC, increased rates by 0.75%. So they're taken their benchmark Fed funds rate to about 2.5% now. Now, Powell highlighted with a Fed funds rate range somewhere between 3 to 3.5% by year end. Okay, so there is there is expected rate hikes in the upcoming months. The next one is due in September, so we've got some leeway up until that time period to wait for information, wait for incoming data. But something that pivoted markets, right? So we actually saw rather than markets seeing a 75 basis point rate rise, seeing fear and panic and then, equity sell off, we had the inverse. We actually saw that during the press conference, Jerome Powell, came out quite in a dovish tone. It was more of a dovish pivot, which led to equity markets to rally. The key point coming out from there, from the meeting itself, the press conference, is the fact that they are now more data dependent. So what we're seeing is a move away from inflation is the key area of focus for them, or inflation is what they want to control, and they're doing everything they can to fight inflation. That is not the narrative going forward now. Going forward, as we see that incoming data is probably going to be a key focus. So it's not just inflation report that they're focused on all other areas as well, macroeconomic data. From last week, Wednesday, we had a 75 basis point rate hike. The next meeting is in September. So we got 5 to 6 weeks from now before a decision is made. And the question is we saw a dovish pivot from Fed speech by Jay Powell, okay, which means that they are now more data dependent rather than fighting inflation. Other than that, the next sort of key important area, and this is probably the main reason that we're seeing now that the Fed have pivoted away from just inflation being their main focus to now, looking at a wider set of data coming in, right? And that is because of this here, the advanced GDP quarter-on-quarter figure. As you can see, there was another fall in the quarterly result of the GDP figure. So what this means is that we've seen now contraction taking place in 2 quarters. And generally the definition for a technical recession, shall we call it, not a recession, a technical recession by economists, is if you see 2 negative or contraction sort of results from 2 quarters, 6 months worth of negative GDP is what the focus is. But recently there is that big debate, especially last week, one of the big debates that came across is, now we're seeing that we're in a technical recession, but the US government is stating that they are not in a technical recession. We don't declare, 2 negative GDP quarterly results as a recession, right? We look at a much wider variety of data to really outline whether there is it's seen as a negative, okay? And I can actually probably bring up something if I have it here, and it will show you the difference between the two. I should have actually pre-prepared this, but let me see if I can just bring this up now. I have it somewhere here. Just give me a moment. Right, bring this up on the screen. One of our members had shared this with me. So what this is showing you is the difference between the two. Okay, so a dictionary, you can clearly see that a recession is defined by a period of temporary economic decline during which trade and industrial activity are reduced. So the key point being there is identified by a fall in GDP in 2 successive quarters. That's the sort of the key definition there, right? But again, we had WH.gov come out and state their own version of what the definition is of a recession. So what is a definition? While some maintain that 2 consecutive quarters of falling real GDP constitutes as a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. Instead, both official determinations of recession and economists' assessment of economic activity are based on a holistic look at the data, which includes labor market conditions, which we know in the US is quite stabilized. I'll show you in a minute or so that as well. Consumer and business spending rates, industrial production, so looking at the manufacturing side of things, right? And how incomes are viewed as well on an ongoing basis. So based on these data, it is unlikely that the decline in GDP in the first quarter of this year, even if followed by another GDP decline in the second quarter, indicates a recession. So this was released pre-GDP results. So it's almost they kind of knew what the results are going to be, and the prepared markets are preparing you as a trader and market participant that don't see this as a very blim view or negative view. You've got to see a broader picture of the data that we look at to really define whether we're in a recession, in a technical recession. So that was sort of the key highlight from that GDP result. Yeah. So you can quite quickly see that negative GDP of 2 quarters. I'll just bring that up with this little chart here, and I'll just zoom right to the end. There we are. So we're at 2 contraction sort of quarters, which is a technical recession. The key is that going to translate into a real recession? Oh, we'll see. We'll see. Okay. Okay, so that covers sort of the 2 key data points from last week. Other than that, we had towards the end of last week on Friday with the core PCE price index month-to-month figure. This is I want to say it's somewhere between leading to coincident indicator, whereas the GDP, the quarterly figure, is quite lagging. So this is one of sort of the key gauges for the Fed to make those types of decision. And let me just make this very sort of clear to you now. Now that we know that the Fed are more data dependent, we're certainly going to see with incoming data and high impact data, as we can see sort of, from Friday session, the market is going to put a lot more emphasis on that data point, okay? And therefore, we could see great amount of volatility occurring on individual sort of data points throughout the trading sessions in the upcoming week, okay? And that is likely to be, the real focus now is that we know that central bankers are going to be looking at a variety of these data points, and that includes, non-farm payrolls, unemployment rates, consumer sort of, reports. All of these sort of, will matter in the upcoming few weeks, because that's where the Fed is going to be viewing to make that, next decision. Okay, so that's sort of the macroeconomic view there. Looking at the microeconomic view, which is earning reports are at, it's in full swing at the moment. So we know that a large number of corporations have released some of their earnings, and that's what's been the holistic view from that. So what I say is I'll give you a key stat as well, but what I'll say is quarterly earnings, especially from, for example, Alphabet and Amazon, were much better than forecasted, and which produced on a single day a 4% gain in the Nasdaq as well. So we've seen some of the tech companies not come out quite negative reports as markets anticipated. So I believe I have a key stat here somewhere. Let's have a look. Yeah, so far, 78% of reports have come in better than their forecasts. Okay, so in the S&P 500, 78% of the reports that we've had so far have beaten expectations, which is why we've seen that there's been a bit of an equity rally, right? So there's been a bull market sort of rally taking place in the last few weeks, and July closed out to be actually a very good month, considering what's happened in the previous months, year to date. Okay, so moving on, I'd also mention we spoke about Fed last week, earning reports, 78% had beaten those in their forecasts. And we spoke about the GDP, which means that we're in a technical recession, and the Fed pivoting towards a more data-dependent view. And just coming over to sort of the market, so you can quickly have a sort of snapshot view there. This is what we're seeing. So if we're just looking at, if I just hit a refresh there and there. So most certainly we're seeing now, especially US markets, have a much more bullish step in front of them, right? So we can see, making a succession of higher highs and higher lows, right? And that's what we've seen is they're back up to sort of a key level of resistance. So we're trading in this zone over here in the S&P 500 above the 4,000 figure. So we'll see if there's, is there some a significant resistance level being met over here, similar to the Nasdaq, which is also retesting that previous high around the 13,000 figure as well. Yeah, FTSE 100 also, being a constituent of 100 national, sort of international companies included in there. We're seeing a strong rally coming back to sort of test the 75 figure, so 7,500 figure. We're also seeing a recovery in the DAX. So even the European markets is following the path of all other equity markets in this bull recovery. Question is, have we formed the bottom yet? And now, is this the next new bull rally? I think you need to be a little bit more patient. I think there's going to be a longer stretch of a bear market, but we're going to have within this bear market some, bull rallies within that. Yeah. Okay, so we now know that some equity markets are facing those key levels of resistance, especially the US markets, as we've seen the month of June posting their best monthly gain. So the month of June posted its best monthly gain since 2020. So, a 2-year sort of, gain high in equity markets. Okay, so moving on to the week ahead. Okay, so moving on to the week ahead, let's switch over to this week. All right. Now, what I can start off with is Monday. You can see here we've got a lot of PMI data. Okay, PMI data globally is going to be released, and that's going to give us an indication to how is manufacturing sort of, taking place. So we've got purchases managers indexes sort of releases throughout for both manufacturing and services. It's going to be taking place today. We're going to have some of this data coming out on Thursday as well. But that's not where the real focus is. Okay, where the real focus is going to be is, well, Tuesday overnight, we're going to have the RBA, Reserve Bank of Australia, releasing their rate decision. Okay, so we've got RBA releasing their rate decision. Now, just looking at, so far, this is what it looks like so far. Okay, so this is Reserve Bank of Australia cash rate. the sort of the strong line over here you can see is the cash rate, and this is the implied. So the dotted line is where you see the market's view of which direction we're going and how aggressive that view is, right? So you can see it's quite an aggressive view. We're expecting another 50 basis point rate hike by Governor Philip Lowe. And it's just going to continue with the rhetoric that we're seeing globally, right? So we're still fighting inflation, and that's a global theme that's in occurrence. Okay, so RBA are likely to raise rates by 50 basis points. Okay, I can just close that window actually. Yeah, so that's the sort of the next one that you're going to be focused on. We do have JOLTS job opening. Employment change, so JOLTS job openings for the US, and then we've got employment change quarter-to-quarter figure. It's a bit of a lagging indicator for Kiwi. Then moving on to the Swiss CPI figure as well. The Swiss CPI figure going to come through. Again, as I mentioned, there's ISM sort of manufacturing and services, PMI data being released, but all eyes will be on the Bank of England. Okay, all eyes will be on the Bank of England. The question is, are we going to see another hike, right? So this is what we've seen so far. Yeah. So the Bank of England has stuck to a 25 basis point incremental gain since December of last year, right? So since December of last year. Now that is successively sort of consecutive gains, okay, of 25 basis point rate rises since December. Yeah. And now the question is that enough, right? Is that enough, right? Because that's the sort of the key point that you need to sort of take on board. So much so that if I bring up, just give me a moment. It's here. The outlook is markets put 87% chance of a BoE hiking rates by 50 basis point, right? So the question is this, right? That is the Bank of England going to continue with this 25 basis point sort of gradual rate rise with every meeting, or are they going to really up the game a little bit, right, to really tame inflation, because it's not working? What they've been doing so far, the key point is it is not working. And that's why we may see that they might become a little bit more aggressive by raising it by 50 basis points. As we've seen previously, both the ECB raised rates by 50 basis points rather than 25 basis points, and we've seen the Fed raise by 75 basis points instead of 50 basis points. Okay, so we're seeing, are they going to follow the Fed and the ECB in regards to raising rates a little bit higher than anticipated originally, right? Even though markets are beginning to now price in an 87% chance of a 50 basis point rate rise. Clearly, there is some concern for Andrew Bailey here and co. Now, the key concern is the weakness in sterling that's being led by clearly the cost of living crisis that we're seeing, as well as political uncertainty. Okay, so we're not sure who's going to be the next PM, but there is that still uncertainty around that, in addition to the cost of living crisis and how that can be controlled, considering where inflation is at this current moment. And as you can see, this is what we're seeing in regards to inflation here, right? So, we're seeing January of this year, 5.1%, then 6.2%, 7%, 9%, 9.1%, 9.4%. Okay, it's a little bit more gradual, as you can see. But, I mean, it was Andrew Bailey himself who stated that we could see inflation hitting double digits, especially that we're seeing now that electricity bills from October are going to rise by 77% in the UK. So there is certainly a lot more inflationary pressures taking place in the UK. And that's why the Bank of England must put in a little bit more of a significant step rather than a incremental 25 basis point rate rise. But a key point, I think there was something that was mentioned in this article as well, that the Bank of England to rip up history books at this week's rate decision, meaning that if they raise rates by 50 basis points, that's one of the first times that they've provided a surprise as such and raised rates at such a large amount in many years, if not a couple of decades. In addition to that, this will be the first time we've seen a Bank of England raise rates successively 6 times. Okay, so that was sort of one of the key points that was taken from this article in regards to them ripping the books, the history books, when it comes to rate decisions by Andrew Bailey himself, right? Okay, so I'll just remove that out of the way for the time being. We can close this so we know what the forward guidance is there, right? In addition to that, we have another sort of RBA monetary policy statement being released after the towards the end of the week. That's towards the end of the week. Something else to also be mindful of, as it is for each new month, the first Friday of each month, we see non-farm payrolls being released. That is also going to be on the cards for the week ahead. Now, with non-farm payrolls, what we have to be mindful of is, let's bring this chart up. This is what it looks like at this current moment. And this is why we're seeing the Fed pivot slightly, right? So even though the US has very low unemployment rate, it has a very low unemployment rate, as you can see, right? They're around somewhere 3.2, 3.6%, sort of 3.4 to 3.6% sort of, levels in that range there. Yeah. But another concern for them is the fact that their jobs growth is slowing as GDP contracts for second straight quarter. Okay, so just the amount of employment payrolls change is slowing down in the US as well. So that's the biggest concern, is that, are they slowing down and turning from a technical recession into a real recession, or are still markets buoyant in this tough market conditions that we're in, with inflation sort of being the key theme and supply chain issues as well, if you sort of look on that side of things as well. Yeah, so this is sort of the key data point to view when it comes to the end of this trading week, where the focus will be on non-farm payrolls. Certainly any big changes here is going to be instrumental, as we know, Fed is data dependent. Okay, and that sort of wraps up the week sort of in regards to economic data. As I've mentioned, you also need to be mindful of other elements as well, which will be obviously earning reports this week as well. So there's quite a few earning reports to be released this week as well. From the political side as well, from geopolitics, you need to be sort of concerned about what's taking place there. So the sort of key highlights I can mention right now is, I'll start with, obviously in the UK, we have a political race between Rishi Sunak and Liz Truss. It seems like Liz Truss is ahead at this current moment, but Rishi Sunak is coming out with his own views on how he can, offer tax reduction or tax cuts in some way or another, which is something that he wasn't doing initially in his campaign. So we've got that uncertainty there. In addition to that, in the Euro region, now the Euro region really is concerning for me, because obviously we've got a potential GDP to debt crisis, so a governmental debt crisis on the cards again from what happened in 2010 through to 2013. Are the ECB, have they created the right tools that could really mitigate that risk? But that risk is certainly growing, as we've seen Mario Draghi, who was once the head of ECB and said whatever it takes in 2010, 2012, I think it was 2012, he stated that in regards to the debt crisis then, right, he'll do whatever it takes. Will Christine Lagarde now do the same thing in regards to mitigating the debt crisis in the Euro bloc? Now, Mario Draghi, he's had to resign from his role as PM in Italy. Now the question is, who will be the next front office in Italy in regards to the sort of leadership race there? Now, there is questions of the next majority that comes in could be seen as a right-wing party, where there might be more Eurosceptics. We've already seen that there's a right-wing sort of parties growing in the Euro region as well. So that includes, I believe, it's Poland as well. So yeah, and they are Eurosceptics, meaning that they could indicate that they want to come out of the euro and the eurozone itself, right? The euro bloc, should we say? Okay, so yeah, that's obviously an area of concern from a geopolitical standpoint. And the final sort of point to also mention, which you might have already heard of, which is, of course, in the US, you've got now Joe Biden, who's got a second bout of COVID after just, almost declaring himself fully recovered within a few days of being fully recovered from the first bout of COVID, as being one of the key concerns. We're seeing in the Asia Pacific region that there is a lot of concern around COVID cases gaining again with this new Omicron variant. But most importantly, what's been happening is the fact that the third most important person in the US is Nancy Pelosi, the House Speaker, and she's heading over to Asia to do a tour to sort of promote governmental sort of cooperation. Now, they had sort of mentioned that they would go to Taiwan, and it seems like China's not sort of keen on them coming over to Taiwan, and they could enforce military action, shall we say. So yes, there is a concern between the US and China. I know that US Joe Biden and President Xi Jinping had a conversation last week, end of last week, but it didn't materialize to any sort of any commitments, shall we say, at this moment there. So on a political standpoint, you've got to be in focus, and that's not even discussing what's taking place in Russia and Ukraine, which I think now's come, it's emerged back in the sort of, it's emerged into the background, shall we say. But there is that situation that's ongoing, obviously. Looking at some of those sort of key markets now. Now, we can start off with the US dollar, actually. That's where the focus has been. Now, with the US dollar, it's followed some weakness since the Fed rate decision, as we saw hit Jay Powell pivot. And so we saw an equity rally, and then we saw the inverse in the dollar, and the dollar has softened, shall we say, since then. Whereas once reaching highs of 109, it's now back trading at 105.41 figure, right? And that likely may continue, right? That could continue. So what we could be seeing is a medium-term top that's occurred in the dollar so far, up until maybe September, October, where we might see a bit more of an incentive to raise rates, so we can see the next leg higher. But at the moment, it does seem that the view for the dollar is more to the downside. When it comes to the euro, as I mentioned, there is still a lot of concern in the euro region. And the euro really has failed to show, any follow through after the previous week's strong session, right? So we've seen a strong rebound, but we need to sort of break through some of these key levels of resistance, right? And that the key resistance is in this region here, where we are now trading around 1.0269, right? So if we sort of break these sort of recent resistance levels being placed in sort of mid-July, then certainly we could see sort of the next leg higher back up to sort of test the 103, 136 handle there, right? So back to sort of this key level of resistance. The pound, if we have a quick look at the pound also. Now the pound is continuing to rise. It's continuing to rise. It's making some good headway, some strong sort of movements occurring in the pound. The pound finally sort of, it was weak for some period of time, and that was led to the uncertainty of Boris Johnson, and then Boris Johnson is one of the first he is the first PM to have the highest numbers of resignation in the shortest period of time. Right, within 48 hours, he had 50 plus resignations amongst his administration. So that led to a lot of uncertainty. But since then, we've seen a bit of a U-turn occurring, as now Liz Truss becomes the one in front to take the role as PM, because her policies are more impactful right now for markets. It's more positive for markets now, right? So tax reductions and sort of all of these sort of key influences that she's going to put into place is certainly good for the markets in the very short term, right? Now the question is, doing what you may do, is that going to impact inflation further? Well, she might be looking to kick the can down the road for someone else to focus on that or focus on that later. But hey, they've got their own strategy. So Rishi Sunak wants to tackle inflation right now, and it seems like Liz Truss wants to tackle it from 2 to 3 years from now, but really sort of allow the markets to recover from this cost of living crisis at this current moment. Okay, and so we've seen a bit of a recovery in the pound since then. And if you're looking at commodity-based currencies, it seems like they're all performed quite well against risk assets, especially if you're looking at the dollar coming off. Now we've seen strength in the Aussie, the Kiwi, and the CAD. They all rallied, and they were up around 1% from last week. The Norwegian krona actually did quite well; it was up 2.5%. The Swiss franc, the Mexican peso, all these rose 1%, and we saw one of the biggest gain, if you're looking at sort of major sort of currencies, is the yen. So looking at the yen, if we look at the dollar yen, and we're looking at sterling yen, I mean dollar yen will be the key focus there. It's recovered, so clearly the US weakness, US dollar weakness, has allowed the yen to come back into sort of some level of strength, even though there was a divergence of 10% or so year to date. Okay, right. What else we can look at is we covered the equity markets already, so I won't need to go through that again. But we'll have a look at the oil markets. Okay, so oil continues to trade sideways. It's trading around the 100 figure. It crosses above, tests 102, 103 handle, and then it recovers back down to sort of the 95, 96 handle. And now it's just trading just shy of 100, the round psychological figure. It's at 99.05, right? Now, where is the focus? I think that's the key element still is in the background. What I'd probably mention is that from a fundamental standpoint, there's not a lot of new news that's come into this, right? All we know is that, okay, maybe in Libya, we're seeing that their production levels could be raised. We know this week's going to be an important week. We've got an OPEC meeting coming through. So with that meeting, we're going to have a bit more insight to what their new production levels are going to be, or are they going to meet what they previously mentioned of raising the production levels on a month-on-month basis? Are they going to meet the August target? That's sort of the key question there. Now, if they meet those levels, is there enough demand for that? And that's the sort of other side to it, right? Now, if we see, COVID cases rise and continue to rise again, and we've got this zero COVID policy in China, that could cause more shutdowns or more restrictions, and then we see sort of, price of oil slump again as the demand weakens. So that's sort of the key focus there. But at the moment, we're trading sort of at this key figure, $100 mark. And I'll be looking for a strong breakout, either through a key support level, I want to see a strong break through the support level, or back above this resistance around the 106 handle as well. Yeah. Looking at precious metals, let me just refresh this. Okay. As I mentioned, and I mentioned this in my last week's weekly market analysis, we hit that strong support level, and that's where we was looking for buying sort of indication, and what a buy was, right? So we've seen sort of markets come back up to sort of the key level resistance around 70.72 at this current moment, trading at the next level resistance. Obviously, is going to be the 17.84 handle, where we've got this sort of key level support. Is that going to turn into resistance? So absolutely, we've seen precious metals, had certainly recovered somewhat. We've seen that both in gold and silver, where they've been underperforming for some months, and now they just finally sort of had that major thrust forward. Now the question is, we need to see key levels of resistance being broken. Okay, so I'm looking for clear structure in price action to confirm that we're in a now bull trend, because that's not what we're seeing at this moment. We're just seeing a recovery of the most recent downside movement, right? So it's a correction of the sort of sell-off that we've seen at the moment, or pullback of the sell-off that we've seen at this current moment. Okay, so that covers sort of all key markets there. We can have a look at the crypto space as well, crypto markets. Now with the crypto markets, something to sort of mention there is we've seen a bit of a bull rally, right? So, from where we were once, sort of, if I come back and zoom out a little, sort of hitting these significant lows. Okay, so we sort of hit a low in Bitcoin around 17,620. For ETH, it was around 877. Since then, we've seen a strong recovery. Okay, so the month of July was one of the best performing months for cryptos year to date, right? Since November, actually, of last year. But is that going to continue? Is that going to continue? Now, what we did have from last week in regards to fundamentals of news is the SEC getting certainly more involved from a regulatory standpoint, okay? And the SEC is providing regulatory clarity, but just not how anyone wants them to do it, right? That's the sort of key question there. Now, they have put in should we say, a lawsuit or sort of some action, legal action against Coinbase, but markets didn't really sell off on that. So just note that, when you listen to incoming data, that data or fundamentals, right, or that news, right, you would want to see price action, move on that information. And it doesn't seem that's what happened, right? So Coinbase itself sold off, right? So, as Coinbase, it's a listed company. It's a publicly traded company. They IPO'd quite a few years ago, actually. So it's been publicly traded for well over a year or so. And, it's had an idiosyncratic sell-off, right? So based on what SEC has carried out, we've seen a bit of a sell-off occurring, right? So we know that Coinbase is down by around 20% or less, just less than that. Now, I would certainly sort of, share this article with you if I could. I'll share it with our sort of members. This is a good read, actually, for you guys. Now, it seems like the Securities and Exchange Commission alleged that 9 cryptocurrencies are security, and what they have against Coinbase is in regards to them listing certain cryptocurrencies which they don't define as securities, right? So we'll have to wait and see and listen to more information. Yeah, but yeah, so this will be sort of a good read here, but it does seem that we are moving in the right direction, whilst obviously there's going to be idiosyncratic issues. That's the sort of the key focus there, right? So clearly the SEC have now expanded their list of what is defined as a security with their Howey test, right? So with the Howey test, now they've got 9 securities, 9 cryptocurrencies that they define as a security. So that's great progress. That's great progress. But the question is, there's going to be issues as well. Okay, there's going to be issues as we've seen that the SEC is challenging Coinbase in regards to sort of 2 matters, I believe. One was the insider trading, and the second is obviously the listing of assets that they don't define as securities, right? And that's it from me, guys. That's it from me. That's a market wrap. Thank you for joining in this session. Hopefully this has been insightful. I will see you on the next one. Every Mondays we do a weekly market analysis, so please do join. Take care. Bye-bye.